Good morning, everyone. Thank you so much for watching my YouTube channel. Let's see, guys. SPY, Nasdaq, SPY, guys, negative 0.7, and Nasdaq is negative 1%, and then Bitcoin is negative 0.7. And stock today, guys, very volatile, especially you see Tesla, Apple. You see Apple is killing it. See, Apple is killing it, guys. It's coming down too much, and I want to show you the news. Yeah, guys, when you see over Apple here, a lot of news coming in. UK online safety pills put Apple iMessage feature on doubt. We saw China also, guys, banning Apple, and that's the bad news for stock. Tesla also cut the price from Shanghai. Let me see that one. You see over is a Hilton install up to 20,000 Tesla. That is the part of the great news. And I want to play some videos, guys. I don't want to do much today. And let's start with this one.
It seems like on a daily basis the data changes, but the Beige Book is really a fascinating history of the previous month in Middle America, not just the major cities where we tend to focus. So what has the Beige Book told us about the strength of the US economy?
That's true. It does give us kind of like an inside look at a lot of these maybe smaller metrics that are more overlooked. I mean, in terms of the housing market, they talked about how that supply constraint is still apparent. Delinquencies for consumers are picking up. So it's nothing that we really haven't heard before. Unfortunately for the market action, it wasn't very exciting because I think the treasury market had sold off so much on that ISM data that was really strong. Maybe on a day that we didn't have that, we would see rates move a little bit lower on a report like this because it did show inflation starting to moderate, growth slowing a little bit, but that market was very high today. We did see those yields up.
So, guys, when you see that the part of the news, guys, which making Apple, Tesla is about rate hike, and I think, guys, if we need to buy, I think today is time to buy Apple. I'm sure that by if Apple will come down, for me, I will start loading Apple on 200 and 175. I think that's where we can go to buy. Yeah, so it's nice, guys. So if you buy right now, don't miss it, and then Apple maybe skyrocket again back to 189, and that profit will be almost 200. No, $14 per share, which is good because, guys, Apple you cannot fear about Apple. That's the good thing on Apple. Apple, Tesla is not something that if they will come down, it's something that will lose a lot of. You can get back your money. So we want to go to see today, guys, what's going, and I will go to do another technicals, but I want to play 1, 2, 3 some videos over here. You hear it, and then yeah. So most of the stock is going to bounces today afternoon, and I don't think it's not going back down. Okay, guys. So I'm going to play this video right now, and see you later.
All right, it's time now for our Muni moment. Negative headlines plaguing cities like San Francisco, and Muni investors are finding that demand is so robust that it isn't being reflected in spreads. Let's get some insights out of our next guest. Kim Friedrichs joining us right now, Managing Director of Fixed Income over at Kane Anderson Rudnick. And it was interesting. Someone put this across my desk here because we hear all this gloom and doom about San Francisco, and I guess you can throw New York, Chicago, and some other big municipalities in there. But you're saying that, well, maybe municipal investors don't seem to mind that? Why not?
You're just not seeing it. What you're basically seeing is that there's very little supply out there, and there is so much demand right now that we're seeing just, there's $5 billion have gone into muni ETFs just this year. And you're just seeing demand, particularly in high price, high tax states, just pushing demand so high that they're not concerned. So what you see is something like an LAMTA is pricing exactly where it should be, in line with a San Francisco BART, a San Francisco BATA. Everything's just in line, and we're seeing just tight spreads, and they haven't moved. BART and BATA have both been downgraded due to what's happening in San Francisco, but we're not seeing that moving into spreads at all.
I am curious that when we talk about some of the issues themselves here, are investors sort of parsing the difference in those issues, meaning like something just sort of like a general obligation type debt versus something that's maybe very specific to, like, I don't know, a toll road or a specific project?
Well, I think there's some of that, and most of these transit issues or some of these different issues have a difference between what we call butts and seats versus sales tax revenues, that type of thing. But even sales tax revenues are being impacted in some places, so you have to look at it. But there's a lot of depths of revenue. Where can we go for different tax sources, that type of things, and what times coverage, like how many times can we.
Give me your instant analysis on how we should be reading this data.
Well, looking at the four sub-indexes that comprise the composite, each one of them was up month over month, which had driven this index to come in at the 54.5. So that was driven by employment up 4 percentage points. And employment still remains a mixed bag for many of the respondents. Some of the industries that comprise this sector, specifically accommodation and food services, had the largest gains, and they're still having difficulty backfilling positions.
Anthony, is this like the last gasp of summer? Is that what we can read? Do we read any seasonality into this?
I think this is actually better than what we've seen historically. We see usually a bit of waning in the summer months as people are on vacation. There's not as much hiring until September, which is typically the pivotal month going into the last quarter. And what we see now is this is even better than what we've seen pre-pandemic levels at that August threshold.
Anthony, I'm looking at a prices paid index, 58.9. Has the Fed got a grip on U.S. inflation yet?
It's a great question, and one of our respondents actually commented on that and said they thought the Fed was doing a great job by staving off inflation with the interest rates, that looking at how prices have moderated from where we were near 80% back just several months ago. Still, prices are increasing, just as not at the levels that we had seen in the past several months.
So, Guy, the market, is it too high?